Alright, greetings. So let's make this fast. So that trade was profitable. I was right. It used that as that support, as a polarity support here. You can see here's the profitable trade here. So that is essentially a 66 pips. I'm discretionarily exiting. It was a few pips away from the target, from the take profit. You can see that here in 1872 and 1865, so about 7 pips away, and I just decided to get out. Made 66.6 pips on that. That was a buy, and that was closed yesterday, I think, right? Yeah, closed on the 9th. Yeah. So, and the price structure that I was operating off of was the what was posted on January 26th. The last day was January 26th. So for the last 2 weeks, I've been using that old price structure, and you can see that it was still usable, still effective. I did correctly trade that because that price structure, if it existed some point in time, that means that that price structure is real, and so it continues to be real. It changes, right? As time passes, it will slowly change. But it's like a mountain. If you take a picture of a mountain or a hill, the hill didn't. You have the picture, and it's it's the next day or the next week, and the hill is still there. You have the picture. The hill looks the same as in the picture as it did last week, or yesterday. So it's very similar to that. So if I have the long-term price structure here, it's not going to change. Just because a week passes, it's not going to change. The price structure is not going to change a lot. So it's the exact same thing of taking a picture of a hill or a mountain, right? You don't expect the mountain or the hill to look very different from the picture the next day. That's exactly what's happening here. You're going to have some slight alterations, right, because of the erosion from the wind or the water, but generally it will still have the same structure. Okay, so that's what's happening. As time passes, we have a slightly little bit different structure, but overall the same. So what I'm going to do is I'm going to I like to update it, update the analysis after a trade, after a couple of trades. So I already used the last couple of weeks. I already got a couple of profitable trades off of the last couple of weeks price structure this price structure that was printed a couple of weeks ago. So I'm going to make a new one now, and I'm just going to set this here as the old one and just keep observing it as the old one. Remember, this is one that's older than that, right? And so when this was made was December 15, right? And so you can see that it is a little, these averages are getting a little bit off of a scale, off of deviation. You can see that right here. So it didn't touch this. It didn't touch the deviation line. It didn't go totally towards the deviation line. And we've got some things that are, it's still following the structure, but it's more identifiable. The structure is more relatable with this, with this structure that we analyzed, a couple of weeks ago. So that's the benefit of making a new analysis. And so I'm just going to make a new analysis here. Put it in. Okay, so I'm just going to make a totally new analysis. Then I will show that. We'll trade that. We're going to do that here. The period separators, I'd like to see that. Get the last 24 hours here. Last 24 hours. so the last day on this one, the last day, and then the last week, 2, 4, 5, as a general rule. The last day, then the last week, and then the last month, and then this is the last 3 months. It should be. The H4, this will be the last, I believe, 6 months. So like a business quarter, then semi-annual, and then the daily is the last, well, you can see 25 to 20, the last 5 years or so. Then the last 25 years, 30 years. So the averages that I'm relating to are longer than, you know, my lifespan. So like this one is, the earliest date here is 1971. So that was before I was born. And so the price structures that I'm analyzing are longer than my lifespan. So for example, I know that the euro versus USD, the euro USD is increasing, it's trending up. You can see that clearly here. And we look like we're currently in that uptrend. You can see that these the H1 time frame and the M15 time frame are looking up towards that monthly uptrend. Price is being supported by the weekly standard deviation. This is the weekly chart. It started in 1995, so about 30 years ago. There's a 30-year average that the euro is currently at, that's being supported actually. So for you to consider that it's in a downtrend, we'll have to break that 30-year average that it's at right now. So that is a very strong support. Get those points up there. Get that off. Okay, and this is that 30-year average is that weekly standard deviation, weekly chart standard deviation. You can see that's what it broke. That was my target previously on this trade. That's how I got that target. Now it's used as support. Clearly broke that. It's being used as support, and so because it clearly broke it, if we zoom in, you can see that there's it's like really no turning back. I mean, really see that it's heading towards this the H4 deviation. So I could put a stop under, like, that would be 42 pips under the weekly standard deviation, or I could even put it under this one, this closer one, which is the M15 standard deviation. And so considering 42 pips would be the largest stop, and the target would be 65. So that's about a 1 to 1.5. That is acceptable, and I will just put that on right now. I'll put the stop here, and the target that H4. You can also see that there's an intersection here, so there is a lot of interest, it appears, that is looking at that H4 deviation, standard deviation. So now what I can do, what I'm thinking here, is that this M15, if this M15 continues to be used as a support as well, the M15 deviation, then I will push up the stop into that position, up closer to there, to minimize the risk. So like we said, we've got some problems with chart viewing, charts showing different time frames. You see the H4 is not there. I mean, so the weekly is not there, but I have the stop there, the stop value. So this is a potential. I could potentially raise this stop to under here. So this is a 24-hour time range that you're seeing here. So within the next 24 hours, if it doesn't fall under this, if it looks like it's making progress and doesn't fall under this line, then I'll push the stop up to this point, to the M15 standard deviation. And so we've got that much to go. So I think what was it, about 60, about 66 pips to hit the H4 standard deviation. So you can see, like, if this keeps following up, you know, along the last 24 hours trend, right, until it hits the potential resistance, H4 potential resistance, then I should just push up the stop here, because there's no use in keeping it down there, because this will act as an inversion. These act as supports, but they also act as inversions, and then will act as a resistance. So these are very strong polarity types. So in other words, they act as very strong support or resistances, very strong polarities. Okay, so that's it. So I have this trade on. You can see we've got a 47 to a 66 pip risk to reward. If this keeps tracking up, if it keeps uptrending, then I'll move it up here to minimize the stop loss.